Over the past few years, we have seen global equities to rise dramatically, especially those in the West. Here's a graph of the famous S&P 500 index, which tracks the performance of 500 of the largest publicly traded companies in the United States. As you can see, the S&P 500 index has gone up significantly, especially since the 2020 COVID-19 pandemic. This story is repeatedly seen in many other major economies like India to Japan. But there's one particular country that has seen the exact opposite of these stock markets, and that is the world's second largest economy, China. Here's a graph on the HK50, which reflects the overall performance of the largest and most liquid companies listed on the Hong Kong Stock Exchange. While we've used the index of Hong Kong, it is important to know that some of the largest companies listed in the Hong Kong Stock Exchange are actually Chinese companies like Tencent, Alibaba, and so on. Now, here you can see that the story isn't the same as the one seen in the West. You can see that the HKG 50 since 2021 has gone down. As a matter of fact, if you take a broader view, including previous years, you'll see that the HKG 50 hasn't really gone up at all since 2010. Here's a comparative graph showing the difference between the HKG 50 and the S&P 500 index. You get to see a clear picture, and that's the fact that the Hong Kong stock market isn't really doing well at all, despite housing some of the largest companies in China. Well, to begin with, the index as a whole may not also tell the entire story. So, let's graph out some of these big companies that are listed in the Hong Kong Stock Exchange. Here's a graph on Tencent's market capitalization. Tencent is well regarded as one of China's technology giants. It owns brands like WeChat, one of the largest messaging platforms in the world, and Tencent Games, a leader in the gaming industry with hits like Honor of Kings and PUBG Mobile. However, when you look at Tencent's market capitalization over the years, you'll notice a significant decline starting in late 2021. In exactly February of 2021, Tencent reached a market capitalization of more than $900 billion, which made it one of the world's most valuable companies at that time. But as of the time of writing, Tencent's market capitalization has plummeted to just $451 billion, which is half than what was seen back in 2021. And it's not just Tencent alone, as you can see from the entire Hong Kong 50. Here's a graph on Alibaba, which is also one of China's big technology companies. Here, you can see that Alibaba has seen way worse decline than Tencent. Back in late 2020, Alibaba was worth more than $830 billion, which was nearly as high as Tencent. But as of the time of writing, Alibaba's market capitalization sits at just around $200 billion, which is a staggering decline of over 75% in just a few years. This decline has actually led many people to lose a lot of money. There were investors, famous investors, that had invested into these Chinese companies. For instance, famous investor Charlie Munger, Warren Buffett's longtime business partner at Berkshire Hathaway, had been a notable supporter of Alibaba. Munger, through the Daily Journal Corporation, significantly increased his stake in Alibaba during its decline, believing it was undervalued. However, even his belief in the company couldn't stop the impact of regulatory pressures, economic challenges, and investor skepticism. Other major investment funds like SoftBank, which had been early backers of Alibaba, also suffered heavy losses as the stock continued to tumble. But this decline in value for many Chinese companies is just one part of the story. There's another major problem, and it's the fact that the Chinese government has introduced so many incentives to revive their stock market. Yet for some reason, the value of these Chinese companies are still down. For instance, China's top securities regulator has limited the usage of short selling in an effort to stabilize the stock market. This was done in July of 2024, where they announced the suspension of securities re-lending. a practice where brokers borrow shares to lend to clients for short selling. Then, they had also raised the minimum margin requirement ratio for short selling from 80% to 100%, with even higher thresholds for hedge funds. This, in essence, made short selling more expensive and less appealing, discouraging speculative bets against the market. But since July of 2024, the Hong Kong stock market hasn't really recovered that much. It only rose from about 18,000 points on the Hang Seng Index in mid-2024 to around 20,000 points by the end of the year, a modest improvement compared to the sharp declines seen in prior years. Then, they had also introduced a lot of tax incentives. In May of 2024, the Ministry of Finance and the State Taxation Administration had started to allow employees of domestic listed companies to defer individual income tax (IIT) payments on equity incentives, such as stock options and restricted stocks, for up to 36 months. This policy aims to encourage long-term investment and align employee interests with company performance. In December of 2024, they had also expanded the private pension system, where participants can invest in tax-advantaged accounts, which would help channel more funds into the stock market. Finally, China has even ordered its state-owned companies, like state-owned insurers and mutual funds, to purchase more shares in domestic companies. Several news reports out there stated that they were required to allocate 30% of their new premiums toward buying shares. A pilot program is even underway in the first half of 2025, which will see at least 100 billion yuan, $13.75 billion from insurers into long-term stock investments. Despite all of this news and actions by the government, we still see a stagnant stock market that has stayed down for years, don't we? So, why is China struggling to revive its stock market? Is it related to the economy of the country? Or are the incentives to make it a viable investment still not enough? Well, to understand this, it is important to talk about the factors that actually led to the decline of the overall Chinese stock market. There are three major reasons for China's stock market to fall. Let's first talk about a major reason for this, and it is no other than regulatory crackdown. Back in 2021, when the Chinese stock market was hitting highs, there was a crackdown in various industries. For instance, the technology sector faced intense scrutiny from the Chinese government. Major companies like Alibaba and Tencent were targeted with antitrust investigations, resulting in hefty fines and stricter regulations. Alibaba, for example, was fined a record $2.8 billion for monopolistic practices. Additionally, the government halted the $37 billion IPO of Ant Group, Alibaba's financial affiliate, which sent shockwaves through the market. This is a major part of why Alibaba's valuation has plummeted so much more than Tencent. Indeed, even though Alibaba as a company is still very healthy, the company's market capitalization was driven downwards due to this. Here's a graph on Alibaba's revenues. As you can see, while Alibaba's market capitalization has declined, the company's revenues have overall gone up. Many observers have witnessed in real time how the co-founder of Alibaba, known as Jack Ma, had even faced backlash from the Chinese government after openly criticizing China's financial regulators during a public speech in late 2020. Following this speech, Jack Ma disappeared from public view for several months, fueling widespread speculation about his safety and the future of Alibaba. This crackdown has then caused Alibaba and a couple of businesses in China to decline in value. To top that off, there's also the property market crisis. Here's a graph of major real estate companies in China. Here you can see that their market capitalization has plummeted massively. Evergrande, which was the face of China's property market crisis, experienced one of the most dramatic declines. Once the country's largest real estate developer, Evergrande defaulted on its debts in late 2021 after failing to meet its financial obligations. The company had accumulated over $300 billion in liabilities, and its collapse sent shockwaves through the property market and the broader Chinese economy. Here you can see just how bad its market capitalization had dropped. A company that was once valued at over $50 billion in 2017 had dropped to around $2 billion in 2023, before it got delisted. Thirdly, there's also the economic slowdown. Here's a graph on China's inflation rate. Here you can see that in some months, China saw small inflation, while in others, downright deflation. This problem has led many investors to keep watch on China's overall future. Many believe that if this is not fixed, it could lead China to become the next Japan, where economic stagnation and deflation persist over decades, commonly referred to as the lost decades. Similar to Japan's situation in the 1990s, China faces the risk of falling into a deflationary trap, where low demand and declining prices discourage spending and investment, further weakening economic growth. Now, as you can see, these are the reasons that led to China's stock market to fall. So, now let's understand why China is struggling to revive the market, despite many incentives. Well, there are a lot of reasons for this, but arguably one of the most important ones out there is the fact that Beijing has not really made enough stimulus for its economy. For instance, in 2024, China introduced a consumption stimulus scheme targeting goods such as cars, home appliances, and electric bicycles. This initiative generated sales of 1.3 trillion yuan, contributing to a 1 percentage point increase in consumption growth. However, several analysts were skeptical about this positive effect, as they claim it is a rather temporary solution to a long-term problem. Another problem was that when the People's Bank of China announced a 300 billion yuan, which was $41.5 billion facility to support the housing market, many analysts were skeptical due to the fact that this was relatively modest compared to the scale of the property sector's challenges. This modest stimulus is what led many analysts and investors to still be cautious about China's future. They still think that it's not enough. This is not limited to the two stimulus reports that we just talked about, as there are a lot out there, and many truly believe that they are not enough. But anyway, do let us know what you think.